Good morning. Um, we are discussing today the principles of property investment. Um, what is interesting, property investment is not a new phenomenon. In one form or another, it's been utilized by people to provide for lean times and during those times that a person is unable to work for hundreds, if not thousands of years, especially during the Middle Ages. The concept developed, especially towards the Industrial Revolution. And interestingly enough, a very interesting quote from Franklin D. Roosevelt, used to be the President of the United States of America. He said the following: real estate cannot be lost or stolen, nor can it be carried away. Purchased with common sense, paid for in full, and managed with reasonable care, it is about the safest investment in the world. Now, that, of course, applies still today. There are, of course, the permutations, and in the modern times, we've added to the principle of paid for in full, and the catchphrase probably in our time is other people's money. What it means, in other words, purchase the property with money borrowed from a bank or a financial institution, and repay this loan, which we call a mortgage, together with the interest, by charging a rent and using the income derived from the property, in other words, the rental paid by the tenant, to pay off the mortgage. This is obviously, if you look at this, a medium to a long-term strategy. Franklin Roosevelt, when he said, if it's paid in full, that is a short to long-term strategy, because it means the purchaser of the property has the money available. It's already been earned. Tax had already been paid in respect of it. So it is after-tax money. And from the very first moment that this property produces income, there is an immediate return on investment. And from that moment onwards, of course, there is capital growth. Whereas nowadays, we propose a strategy which is more aimed towards slowly building a portfolio. And this is, as we will see a little bit later, to a large extent, because we need to provide for the years of retirement. In other words, during those days that you are either unable to work or once you have retired. So, but the basic underlying principle, as Roosevelt had it, remains the same. It is safe, and it's a common sense approach. Now, in South Africa especially, we will deal with the question of inflation and the differences in inflation rates between South Africa and, for example, Europe and the United States during a separate seminar. But in South Africa, we need to understand that inflation is of the utmost importance towards the rate of capital growth of your investment property, and also of utmost importance as far as the growth of your income, in other words, the rental growth year on year, is concerned. Let's just have a brief look at inflation, because if we talk about property investment, we need to understand the concept of inflation, and appreciate the fact that the higher the inflation, the higher the capital growth inherent to your property, and the higher potentially the growth rate of your income, in other words, the rental. Now, as you can see, inflation is basically just a rise in prices, a hiking of prices, which can obviously be translated as the decline of purchasing power over time. The rate at which purchasing power drops can be reflected in the average price increase of a basket of selected goods and services over some period of time. And in South Africa, the South African Reserve Bank makes use of a bouquet of approximately 401 goods and items to determine this increase in basic prices. Now, these the rise in prices, which is regularly expressed as a percentage, means that effectively your money will purchase less than what it had been able to during previous periods. For example, if I paid 100 Rand on the 18th of November 2022 for a bag of potatoes, and if the inflation rate was 7% year on year, in other words, from the 19th of November 2022 until today, the 18th November 2023, if that inflation rate was 7%, then it means that very same bag of potatoes, the same weight, the same quality, will now cost me 107 Rand as opposed to the 100 Rand of a year ago. So this is inflation in action. Now, as you can see, the most commonly used inflation indexes are the Consumer Price Index and the Wholesale Price Index. Now, of course, in the same way that inflation applies to the increase in prices of consumer goods, potatoes, foodstuffs, motor vehicles, and other assets, of course, it will apply to your property, where the rising inflation will result in capital growth of your property. In other words, if you paid for it R1 million a year ago, you would expect at an inflation rate of 7% an approximate growth of 1,070,000. In other words, you paid for it $1 million a year ago, you would expect that value at this point in time then to be approximately 1,070,000. That's the rule of thumb. It fluctuates depending on a large number of economic factors. But that's the underlying principle. But what's more, if your rental income in respect of this property is 10,000 Rand per month, then you would similarly expect, in light of a 7% inflation rate, the rental that was 10,000 Rand a year ago to now have increased to 10,700 Rand per month. That's the underlying principle And therefore, you can see that inflation and the effect of that in the economy is of utmost importance when determining the growth of your investment. Now, I'm not going to spend a lot of time on asset classes, and this is actually something that we should deal with separately. If you can see it on the screen, you're welcome to read through it, but by way of summary, there are in the South African markets so-called REITs, R-E-I-T-S, and the name does not really describe what they do and who they are all that well anymore, because they used to be real estate investment trusts. Now, these are nowadays massive companies, mostly owned by the very large insurance companies and with interest banks will have in it, but they're certainly not trusts anymore. They are in fact companies, public companies, which are specifically registered as so-called maybe we should just backtrack a moment and just explain that there is legislation in South Africa that deals with investment schemes, collective investment schemes. In other words, two or more people come together and purchase an interest in a particular company with the express intention to derive capital growth and or income from that interest. Now, that is called a collective investment scheme, and there is specifically legislation that has the same name in South Africa. This is not unusual legislation, and in most Western economies, we find similar legislation and, of course, the same principle. Now, REITs are practically, and for all intents and purposes, collective investment schemes. A lot of people buy shares in it, and they then derive dividends and potentially and hopefully from their perspective, growth in the price of those shares. So these are really massive companies, and their business is literally to invest in property. As a rule, these companies, the so-called REITs, invest in shopping centers, commercial properties, and to a large extent, they do not invest in residential properties. So the residential property investment market in South Africa specifically, by its very nature, is mostly, or to a large extent, the activity of individuals, you and I, who purchase one particular residential property in a block of flats or somewhere in a neighborhood, and we anticipate this property to provide us with a rental income, and we anticipate this property to grow in value. And that is mostly, to a large extent, as I suggested, driven by individuals participating in this process. Typically, you would receive notification of a project that's being built with 100 or 200 or 50 sectional title units. You would apply you would sign a purchase agreement, or as it's colloquially known, a OTP, offer to purchase. And you would apply to a financial institution, a bank, for a bond with or without a deposit, depending on your credit record and the cycle in the economic climate, and the risk factors. It will be approved by the bank with or without specific conditions. The property would be finished. The transfer of the property into your name will take place simultaneous with the registration of the bond in favor of the bank from whom you borrowed the money. You would then, either through your own efforts, alternatively with the help of a property manager or an agent, procure a tenant for your property at a fair value. From there on in, you would collect the rent, you would pay the levy in terms of the sectional title scheme payable to the body corporate. You would pay the municipal tax charged by the local authority. You would have to maintain the property, make sure everything works, cupboard doors which are damaged, replaced, repaired, etc., etc. And that would constitute an investment, property investment, and it's actually as easy as that. Another possibility is people would purchase a flat and start out. That's their first home. They would then, as the family grows, purchase another property which is bigger, and then instead of selling the existing property, retain it and convert the intention of the property from primary residence to investment. And they would keep the first property, use it for business purposes as an investment, and then move into the new primary residence. So you can see there are a large number of permutations to this. Now, in most modern economies, we classify, we have sub-classifications: residential, which we all know that is; commercial, which is properties used for business activities, shopping malls, retail stores, office space, which is to a large extent the playing field of these REITs that we spoke about. Industrial, to a large extent, that's, for example, warehouses, factories, and properties, buildings designed and suitable for the manufacture and storage of goods. That's also, from an investor perspective, largely the playing field of these REITs. Agriculture is farming activities, and that again is mostly in the hands of individuals, and that property is not necessarily a pure form of investment, because you have to work the land to derive an income from it, because the potential rental income derived from it relating to the price of it is woefully inadequate to classify it from that perspective, from the income potential, as a viable investment. You have to work the land, you have to farm with cattle or maize or something to that effect, or in Africa, a popular one is game farming, etc., for it to become a proper investment. Now, we're not going to deal with too much with the intricate detail, but let's just make sure that we understand, as far as residential housing investment is concerned, we tend to classify them as subclasses. So property is a class of investment, CLASS, as opposed to equity, which would relate to, or which would mean investment in shares. So if we look at a residential property, then we could classify or refer to three distinct sub-segments. The first one is low income. The second segment is middle class housing. And then, of course, we have high income housing. Now, in a country like ours, South Africa, you literally would concentrate, as far as we are concerned, on middle class housing investment. middle-class housing investment would typically be, and this is not a hard and fast boundaries, but you would probably start looking at 350,000 in price of that particular property, up to and including approximately 1.8 million, 2 million. Above that would probably then classify as high income housing. Keep in mind that at current interest rates, if you purchase a property at a price of R1 million, then just based on that, if you pay a 10% deposit, in other words, you borrow 900,000 rand, then at 10.75% interest, your installment will be 9,137 rand. So it is pretty important to understand that if your installment is, let's just call it 10,000 rand, then it means to be one of the criteria that the bank would apply is you would not be allowed to spend more than a maximum of 30% of joint household income. Therefore, it means if you want to purchase a property of R1 million with a 900,000 rand bond, you would have to have an absolute minimum income of approximately 30,000 rand per month, which would make you a middle-class individual. But it would also mean that the housing that you can then afford by way of investment is then, of course, a middle-class housing. And you can see that if you subdivide middle-class housing in low middle income housing and middle income housing and then high middle income housing, then probably you would fall with a 30,000 rand per month income in the middle income middle class category. It's as simple as that. So that more or less explains those categories, and this is today how far we will get with the actual definitions as far as that is concerned. We look at rate of return, and we're going to do this from a practical perspective a little bit later. But as you can see, an investment is an asset that you acquire, of course, as I already stated, with a specific intent of generating an income, and you would, of course, expect capital growth, appreciation of value of that particular asset. We've already discussed if you expect a 7% capital growth, you buy it for R1 million, a year later, you would expect the value to have increased to R1,070,000 rand. So your rate of return and capital growth is therefore calculated on the actual capital that you invest. So do not confuse the price and the money that you put into it. And this is not necessarily an easy concept to grasp, and we're going to explain this a little bit later. Cost of ownership is another term that we use. For example, if you buy a R1 million property and you get 100% bond, then it's 100% loan. Then you would find that your rate of return would be calculated on the purchase price, which is R1 million, and on, of course, the money that you borrow from the bank would be deducted from that. In other words, if you do not give a deposit, then your own contribution is zero because the bank is giving you R1 million, is lending you R1 million. So your contribution is nothing, not a cent. If you pay a 10% deposit, your own contribution is going to be 100,000 because the bank is gonna lend you 900,000. And keep in mind, and as you will see later, we calculate your rate of return on the money that actually comes out of your pocket, not the purchase price. It's two different things. Let's make sure we understand this. If I buy it for R1 million, and I don't pay a deposit, then it means the money that comes out of my pocket is zero. If I buy it for R1 million and I pay a deposit of 100,000, then the money that I take out of my pocket from my own resources is 100,000. And this is important to keep this in mind. Good. Now, let's just have a look at the basic concept of the cost of ownership. And I've just used a basic principle where this was actually when those interest rates were still nice and low. At this point in time, we're sitting at a prime rate, I think, of about 10.75%. So if the balance of the bond in respect of which you bought the property is 684,000, and the bond term was 240 months, 20 years, and the interest rate was 7%, it means you borrowed 100% of the purchase price. Your bond is 684, purchase price was 684. Now, if, for argument's sake, you get a rental income of 6,600, which is a pretty good return, then your installment at 7% over a 20-year period would be 5,303 rand and 4 cents. If your levy, in other words, the contribution towards the maintenance of the buildings, to the body corporate and the homeowners association levy is 482.49, for argument's sake, you pay the municipality towards municipal costs and fees 320. You have an agent who found a tenant and who manages the tenant is 528, and you provide, let's say, 100 Rand per month for maintenance. Then you have a shortfall, not surprisingly, of 133 Rand and 53 per month. Because what you do is there's your gross income, 66, you deduct from it installment, levy, municipal charges, the agent's commission, and what you provide towards maintenance. And if you do that calculation, you come up short with 133. Now that is what we call your cost of ownership. What it cost you, in other words, to own this property. So cost of ownership in this particular figure, example, is then the amount of 133 per month, which translates, of course, to 1,602 per month, which is also the shortfall for that year. That's during year one. It's called a negative cash flow. You spend more than what you earn. Based on the predicted capital growth, if you say my property will grow at a rate of 6% per year, and the income growth of 6%, if you say my property will increase in value with 6% per year, and I will increase my rent at a rate of 6% per year, then it means this property will give you a return over a 5-year period, as you will see here. Have a look at it. There's where we started out with. A year later, by the end of year one, I would have suffered a loss in income of 1,602. But by the end of year one, in other words, 365 days after I bought and took delivery of this property, the value is now increased with 6% to 725. And my rent at the end of year one would now increase, of course, with 6%, because that's what I expected to be increased. My installment will remain the same on condition that the interest rate remains the same. My levy would at that point still be the same, and the same with municipal charges, agents' commission, etc., etc. So, how much did I then invest at this point in time in this property? How much money did I take out of my pocket? The astounding thing about this is I borrowed 100% of the purchase price from the bank. So what I took it out of my top pocket is that shortfall only, and that's 1,620. So my cost of my investment is 1,602 rand. In year two, at the end of that year, the value is now increased with another 6%. So it is then valued at 768,000. My rental has now increased, as you can see, for the year with that 6%. My installment remains the same on condition that the interest rates haven't changed. And the same with my levy may have increased. The municipal charges would have increased because of the effects of inflation. And then, of course, my agent would charge me more, because the agent would charge me, for example, 8% of the total rental income. My maintenance is also now, I applied the inflationary rule. I increased my maintenance provision with 8% or with 6%, the inflation rate that I calculated here, and that's now increased. Now you can see at the end of year two, I have now made a profit, which means I have invested in this property still 1,602. And this is how it continues. Now, if you look at this, you will see I have a rate of return of 2,500%. Why? You can see I paid for it 684. At the end of year one, the value is now 725. So that'll give you approximately 41,000. Have a look again. 684 that I paid for it. Now, at the end of the year one, it's worth 725, which means the difference between 725 and 684 would give me an exact number of 41,040 Rand capital growth. That's my capital profit. But I've invested only 1,602, which means I made a 41,000 Rand profit by investing 1,600 Rand. And this is why you get this massive return on investment. And I hope that this makes sense, because this is a pretty important concept. So if we now look again at the actual cost of ownership, where you took all the money from your own pocket, you didn't borrow the money, and your purchase price is 684. Your rental is still the same, levy is still the same, you do not have an installment. Now, your cost of ownership, of course, is you don't have any cost of ownership, because you make more money than what you pay. You have a positive cash flow of 5,353. Now, cost of ownership means how much does it cost me to own this asset? Now, it doesn't cost me anything if I do the total calculation. I have an income above expense. And here's how I calculate that. Again, at the end of year one, that's the value. That's my income from it. I don't have any installments. There's my levy, my tax, my agent's commission, my maintenance. So I have a negative cost of ownership. I have a taxable income during year 1 of 64,000 Rand. So what I have invested is 684,000. I've derived an income of 64,000 from it. So my annual rate of return is 15%. Why? I calculate my capital growth of 41,000 and 40,000, my capital growth, plus my net income of 64,000. So in other words, my total benefit derived from the ownership of this, my rate of return, is then calculated on 64,000 income plus 41,000 capital growth. And if we add it together, it gives you 105,282 Rand total rate of return, a total return, capital growth plus income, net income. Then if you do that calculation, if what I derived from this property based on the money that I've paid for it is 15% rate of return. Now compare that to where I borrowed the money from the bank, where my rate of return is 2,561%. Why? I've invested only as 1,600 and I've made 41,000. I hope it makes sense. Whereas if I take the money out of my own pocket, instead of borrowing it from the bank, I get still a pretty good return, but it doesn't compare anywhere remote to this return. I hope it's clear. Now, so if we talk about the nature of property investment as an asset class, then it has a TER return. Now, TER is just the old Latin word for 3. In other words, we have a threefold return. The first thing is I get growth, capital growth, year on year on the value of my property. The second one is I derive at some point in time, whether I borrow the money from the bank or not, there will be a point where I will get an income. In other words, my rental income will be more than what I spend towards installments, maintenance, taxes, etc. And the third one will be that income that I get in the form of rental will increase every year because of the nature and the effects of inflation. And now you understand why we keep on harping on what inflation is and what the effect of it is on the economy. Good. Just for interest's sake, that whole concept of inflation and the continued growth in prices has the following. I went back and I had a look at a particular house price of a particular property way back in 1966. And at that point in time, you can see the price was minute compared to today. And over the years, until approximately 2014, I actually literally took the statistics from 1966 to 2014. The house that I bought here for a few thousand Rand is now in 2014 would cost that very same house, because of the effect of inflation, 1,275,530 Rand. That's the nominal house prices in South Africa specifically over that period. And that is so significant. And this is actually the index provided by ABSA in their documentation and records. So what is interesting is this is the quarterly rental growth of properties. And The reason why I always say all of this is subject to the economic environment and what happens in the world. Have a look at this. Is the capital growth and the income growth in respect of property during the first quarter of 2019 all the way up to the third quarter of 2022. No, in other words, the penultimate quarter of 2022. Look at what happens. It was going along nicely, growth of 3.9% during that quarter. A quarter, in other words, 12 divided by 4, 3 months per time. So first 3 months of 2019, we had a 3.9% growth. Very nice. The second 3 months, so in other words, April, May, and June, we had a growth of 3.9% during those 3 months. Then July, August, and September, we had a really good growth, exceptional growth of 4% in house prices and income prices, rental prices. And then at the end of 2019, October, November, and December, the warning signs started. We had a drop in growth, 3.3% during those 3 months. And this thing started having an impact. Early in 2020, January, February, and March, we saw another decline, growth 3.2%. And then, of course, April, May, and June, it dropped. The bottom started falling out of it. 1.6%. Then July, August, and September, it came down another 1 to 1.5. October, November, and December of 2022, the bottom fell out of it completely. Why? COVID, lockdown throughout the world. And the effect of lockdown was that during the period October, November, and December of 2020, we only saw a 0.2% growth in capital value and income value during those 3 months. And that's why we always say, it is not a linear or growth in a straight line. It fluctuates. It does this. And it's always subject to what is happening in the economy. Now you can see we got through lockdown, as we see there, and then look at this steep growth. Then from the first, almost the last quarter of 2021, and there we see it increasing dramatically. And this is the visual aid that we see here, explains exactly how we should look at property investment. It's not a straight or a linear line. It is always, of course, fluctuating, but we measure it in the long term. Now, there's a very nice graph, as you can see, which I suspect we got from TPN, and that gives you a very nice indication of what happened during these periods from January 2020 all the way to 2023, and the index. And this was properties for sale and the volumes. You can see from 2014, there's a graph of the sale of properties and the prices, you can see. So this is the number of sales during 2014. Was just under 400,000 units were sold during 2014 in South Africa, and for that period. And The red line is the price that the seller asked for it. And that's the average price of properties. And then the average sale price, in other words, the difference between what the seller wanted and what the seller actually got for it. You can see there was a significant difference. And that's just for interest sake. Very well. Now, if I can use the opportunity, here is, just for interest sake, a little bit of a retirement plan. I took the numbers and I said, okay, this particular individual is now 64 years old. His annual income is approximately 30,000 per month. And we estimate the inflationary impact on money and increases at about 7%, which is as close to the truth as we can get at this point in time. And at this stage, he has accumulated in his pension fund approximately 4 million rand. Now, he's not going to increase it, and if we estimate a really progressive return of 8%, because remember, we're talking about a pension scheme where the fund managers would invest the money in your pension scheme, mostly a large portion of it in the money markets, in listed shares and capitals. We refer to it as equity markets. And then if you, after deductions and fees and costs and commissions, if you then get 8%, then count yourself lucky if you get an 8% return. Now, if you want, upon retirement at age 65, and if you say, okay, let's say I'm going to live for another 30 years, and I want 70% of the money that I earned upon retirement, I want from day one when I retire. So in other words, 70% of 30,000 per month would give you approximately 22,000. Let's just make this one interesting and make it 68%. Then it means immediately you will take a one-third reduction in your income. What it then means, your 4 million rand that you've saved after contributing for approximately 40 years to your pension fund, the following will happen. Have a look at what I said there. Oops. This plan will only provide income for you until age 83. Then it will be depleted. Look at that. There's your graph. And that's the sad truth, unfortunately. Because have a look at this. If you look at this, it starts out here at just approximately over 4 million. There's it. And the capital that you have will start coming down until just short of age 84. You will outlive your money. Means you will not have any money left in your pension scheme. The reason for it being that it is inflation in action. If you pay now 100 rand for a bag of potatoes, and the inflation is 7%, the inflationary pressure, next year this time you're going to pay 107 for this bag of potatoes, which means you have to keep on increasing the amount that you withdraw from your pension scheme, and the growth that you will get on your capital sitting in that fund is then not enough to keep that fund intact. And here is the problem with it. Look at that. There's the decrease. It means I will get during, when I retire, age 65, my monthly income will now be 21,000. Now the tax on this will be just under 2,000 per month, which means I will get approximately 19,800, just under 20,000 per month net income after tax. Whereas I was used to approximately on a 30,000 Rand per month income to approximately 26,000 per month. So you can see the immediate knock that I take when I retire. And what then happens, just to keep up with inflation, I have to withdraw more and more every year. But the problem is, by the time that I'm 83 years old, just before I turn 84, I would have depleted the money that I had in my pension scheme. And you can see, there's the end of it. I will not have any money when I wake up that morning and I now celebrate my 84th. How's this for bad news? Yes, unfortunately, because in this example that I used here, I take the 4 million Rand that I've accumulated in my pension fund, and I invest it in what we call a living annuity. I invest this money with an insurance company. I give it to them. I ask them to manage it for me, and I tell them I want just about 7% of the original capital value of my fund every year. But I will outlive my money, and that's the sad truth. Good. So there's the reality. Then if we start looking at, let's just take an example of a property. It's one of our projects in Kempton Park, I believe this one is. It's called Peacehaven, and I'm going to use this example just to demonstrate to you how all of this, all the mumbo jumbo, all the theory that we've now discussed, let's apply this. I buy this property for 733,400. It's brand new. Our research shows that we're going to get a 5% capital growth. And actually, the debt number has now increased to 6%. Let's do that. You'll see how it changes. And my inflation rate will be 5.5%, notwithstanding what everybody else thinks. And the 4.5% that the Reserve Bank pursues and prays for is not attainable in our economy. I borrow 90%, so I pay 10% deposit. So out of my pocket, I take 73,340, and I borrow from the bank, look at this, 660. I get it over 20 years, 240, and currently my interest rate is 10.75. Do not be surprised if it goes up with another 0.25% before it starts coming down. I suspect more or less end of April, early May next year, perhaps. Now, that'll mean on the amount that I borrow from the bank, 660,000, my installment will be 6,701. I know that I can get for this property once it's built 6,550, and I have to say the market has now gone up. That is now 6,600 that I can now get for it. In this particular property, I think I did something to change the numbers that I shouldn't have. There we go. Okay, I see what I did. So what happens now is in this particular development, the first year, I think, is the levy for the investor purchaser is free, or the first 6 months. And that's why the levy payable during year one is so low. But there's all the numbers that we've already discussed, which means I spent, by the end of year one, I've invested in this property 79,000 because I've paid, look at this, 73,240 towards a deposit. and I have a shortfall of 5,600 in year one, add the two together, I have invested 79,000 in this property. My property has grown in value to 770, am I right? Which means my return on investment during year one, even though I have a shortfall, is 46%. And you can see it carries on like this. So because of the inflation rate, at the end of year 10, my property is increased in value from 733 to 1,194,000, which of course you would have seen with my pension fund, the money did not. The value in my pension fund had come down, whereas the value of my asset increased from 733 to 1,194,631. But over and above that, my income, because of the increase in my rental every year, has also grown from where it started out during that first year. And you can see year two, it's 83, year 3, 88. And then during year 10, it's increased to 132,000 for that particular year. So what do we realize? Compared to my pension fund, the growth in capital value, the growth in income, and the security in my property outstrips that of a pension fund, of a monetary investment, so far that there is no comparison. The pension fund gets depleted before age 84, whereas this one continues to grow and gives. And what's more, this tenant is paying off my bond. Now, let's have a look at this. We're not going to deal with tax today. It is a separate seminar which we'll arrange, and just follow us, and we'll send you notification of that. But the reality is, if we look at it from that perspective, that the rate of return that I get here is because of how much I invest. Now, look at the money that I borrow here grows, that I invest grows, because I have a shortfall year 1, 2, 3, 4, and 5. So I have to add that to the money that I invested originally. So how do I get to this number? Upfront, I pay a deposit of 73,340. I add to that my shortfall for year 1, shortfall for year 2, 3, 4, and 5. And by the end of year 5, I have invested from my own pocket 111,956. And the growth that I get in value, as well as the income that I derive from it, I actually get that on my investment of 111,000. And you know what's the interesting part of it? I didn't pay 733,000 Rand for this property. Have a look at this. How much did I pay for this property? I paid for it 111,956,000. And that is the reality. Why? Who paid the rest? My tenants through the years. They will pay it off. Okay, that's more or less the basic principles. So if we go back to where we started, this is the Peacehaven property that I spoke about. Now, this is actually the numbers that I did. And this is more or less where we are at this point in time. This was a brief introduction to property investment. I hope it was worth your time. Think about this. This will actually continue to be available as a video on our YouTube channel. That YouTube channel is the P3 Investment channel. And if you wish to make contact with us at the law firm, there are our contact details. You can communicate with us at info@vanstadeninc.co.za, and the landline number, which is not manned over weekends, but from Monday morning 8 o'clock until Friday afternoon, approximately 1 o'clock, 010-023-2478. And just again, a reminder of our email address where you can contact us, info@vanstadeninc.co.za. I thank you so much for attending this, and I hope it's been a good education and of value.